Okay, hello and welcome to our audience members joining us from across the globe. I'm Raymond Karam, the Chief Program and Development Officer here at the Arab Gulf States Institute. We're gathered here as the war in the region continues in its second week, and our thoughts are with the victims and everyone who is in harm's way. The webinar today will take a closer look at the significant volatility and new uncertainties that this conflict has injected into global energy markets and the Gulf and global economies. We have an incredible panel of experts with us. First, I'll welcome Kate Dourian. She is a non-resident fellow at AGSI, a contributing editor at MEES, and a fellow at the Energy Institute. Previously, she was the regional manager for the Middle East and Gulf states at the World Energy Council, as well as the program officer for the Middle East and North Africa at the International Energy Agency. Also joining us is Tim Callen. Tim is visiting fellow at AGSI. He is the former assistant director in the Middle East and Central Asia Department at the International Monetary Fund and served as the IMF's mission chief for Saudi Arabia and the chief of the Gulf Cooperation Council Countries Division. Last but not least is Robert Mogielnicki. He's a non-resident fellow and former senior resident scholar at AGSI. He's also an adjunct assistant professor at Georgetown University. He's a specialist in the politics, geopolitics, and the political economy of the region and the Gulf countries' role in the global economy. And here is Robin Mills with us. Welcome back to our friend Robin Mills, who is joining us from Dubai. Robin is a non-resident fellow at the AGSI and the CEO of Qamar Energy. He's an expert on energy strategy and economies and economics, and established Qamar Energy in 2015 to meet the need for regionally based Middle East energy insight. And moderating the session today is Ambassador Bill Roebuck. He is the Executive Vice President at AGSI. Before joining the Institute, he was a member of the United States Foreign Service, and he served as Deputy Special Envoy for the Global Coalition Against ISIS and was U.S. Ambassador to Bahrain from 2015 to 2017. And with that, Bill, over to you.
Thank you, Raymond. Good day, everyone. Welcome. We're delighted to have you join us for this important program. We're going to be focused today on the economic and energy shockwaves caused by the military conflict in the Gulf, prompted by the conflict between the U.S. and Israel and Iran on the opposite side. We've assembled AGSI's brain trust on the economic and energy issues. We've got a lot to cover that will include latest developments, Gulf state responses to damage to their energy infrastructure, threats from Iran, and the impact and significance, of course, of the closure of the Strait of Hormuz. We'll also look at energy markets, and we'll look at the broader economic impact of these conflict on Gulf economies, and particularly on their ambitious development programs and their long-term energy diversification programs. We'll also want to consider what recovery will look like when we get to that point. So I want to keep my remarks minimal. I want to get to the experts and give them plenty of opportunity to consider these issues. So let's get started. And I will reiterate what Raymond said about questions. Please formulate your questions and insert them into the Q&A function on the Zoom, and I will fold them in as we proceed. Keep them relatively straightforward as you're formulating them, because I'll be folding them in as I'm moderating. So thank you. So let's get started. Kate, can you set a baseline for us for the discussion? In your insightful article for us on March 9, you described a cascading disruption that's jolting energy markets because of this conflict. Lay out some of the factors that are contributing to this massive disruption that you've described, and what are the key impacts that we're already seeing?
Well, I mean, we started the week with prices close to 120 a barrel, which is the highest since 2022, which is when Russia invaded Ukraine, and everybody expected that there was going to be a massive shortage. It didn't transpire because we have, U.S. is the biggest exporter, producer of oil, and I wrote in an article today for me saying basically, in 2011, we had the tsunami in Japan, and that kind of changed the way that Japan shut down its nuclear power plants, became more reliant on LNG imports, and we're seing now a cutoff of all Qatari LNG, which is unprecedented. And what we are seeing is actually unprecedented. So we've seen this volatility because nobody really knows when oil is going to flow through the Strait of Hormuz, which is effectively shut down, except for a few vessels that are daring to go in. Iranian oil is actually making it out of the strait, which is surprising, which is basically feeding a sort of a regime that is under fire. So it's a kind of scenario that everybody talked about, but never really expected to happen. And because it's so unprecedented, it's very difficult to see where we head from here. But when you have shutdowns of production in various Gulf states, you've got, Iraq was the first to shut down production because they don't have the infrastructure, their storage is filling up. Qatar has declared force majeure. That's, they have nameplate capacity of 77 million tons of LNG per year. And they supply a lot of it to Asia. So you're going to see a scramble. I think gas markets have been more affected than oil, but it's all related. It's a global market, and the LNG market there is no slack. You can't sort of go out and open the taps as you would. So at the moment, we're seeing Saudi Arabia, which is sort of prepared for this eventuality, shipping more from its Red Sea ports, which so far have not been affected. I mean, it's not like when we, in 2023, during the Gaza war, where we saw the Houthis attacking vessels, they've held back. So that outlet is providing a bit of a bit of relief. You've got the UAE, which has a pipeline that can feed into Fujairah, which lies outside the Strait of Hormuz. But it is still a very volatile situation. The IEA Secretary General is speaking now, presumably to talk about the possibility of releasing strategic stocks held by OECD countries. That will sort of help a little bit, and I think that's why we've seen prices come off from the highs. But one should remember that if you release from strategic stocks, at some point you're going to have to refill them again. At what price? How long it takes. So, the market is really in a lot of turmoil at the moment, and nobody can really say for sure where it's going to be heading. And all this disruption is going to take time to resolve. You've got tankers backed up outside the Strait of Hormuz, and it's not just oil and gas. It's food supplies. And I'm sure we're going to be talking about the impact on the economies of certain Gulf states that are not able to export any of their oil, Iraq in particular.
Thank you, Kate. Robin, let me move over to you. How would you describe Gulf states responding to this massive disruption that Kate has laid out for us? And what is your sense? Have we seen the worst of it? Considering the dramatic decline that occurred in prices on March 9 after President Trump made his remarks trying to calm markets, or is this just a lull before the further turbulence?
I think we're seeing just an amazing disconnect between the financial markets for oil and the physical markets. Look, I don't think anybody in the physical market for oil is under any illusions about how serious this is, or that $80 dollars per barrel, or even $90 per barrel is anything like an appropriate price. Asian refiners are scrambling for crude. They are cutting runs. Asian petrochemical companies are cutting runs, going down to 50% capacity. We'll see the same in Europe. We're seeing the same in Australia already, scrambling for refined fuels. So there's no illusions there. And in terms of the seriousness of this, are we at the worst for the closure of Hormuz? Maybe we will see some vessels starting to move. Maybe we will see ships getting more comfortable with going in and out, getting insurance. Maybe some efforts on military escorts and so on, as President Macron has been suggesting recently. I think so far what we've seen in the Gulf is ships coming out. I'm not so sure we see ships keen to go in. I mean, obviously, if you're stuck in there, you may think your best bet is to try and get out and the gauntlet. But if you're safely outside, I think you'll wait until you can be more confident of going in and also coming out again safely. Ship owners, yeah, sure, they're worried about the safety of their vessels. They're worried about the safety of their people. They're also worried about getting a ship stuck in the Gulf and paying high insurance premia and paying high daily rates and not able to use it or to get it out, and having people there and maybe an expensive cargo on board that's stuck. So that's all to be seen. So maybe the maybe the flow of products from the Gulf will improve somewhat, maybe. But we're still in the process of feeding through the disruption of exports into production. We've seen production cuts so far of about 6.5 million barrels per day. Iraq leading because it has very little storage. Then Kuwait, UAE signaling that it has cut at least offshore production. Looks like Saudi offshore production is shutting down as well, and others will follow. Partly because of safety and the safety of facilities, and precautionary rather than physical damage, mostly so far. But more than that, because of storage. Obviously, if your storage for oil or liquefied natural gas fills up and you physically can't export and physically can't put it anywhere, you have to stop production. And better to do that a little bit and in anticipation rather than reach absolute tank tops and have to shut in a rush. So no surprise that those shut-ins have gone ahead, and there'll be more until production is cut back to a level that it can go into domestic refining and domestic markets and the little bit of exports that are possible. Now, of course, both the UAE and Saudi Arabia have alternative pipeline exports. The UAE through the pipeline to Fujairah on the Indian Ocean coast, and the Saudi East-West pipeline to the Red Sea. They're both using those very actively, and that does allow, depending how exactly you count, perhaps 6 to 7 million barrels per day to get out ultimately. There are still logistical issues on those. Fujairah is still somewhat exposed to Iranian attacks. The East-West pipeline, you end up in the Red Sea. Can you then go south from there through past the Bab al-Mandeb and the risk from the Houthis? We'll see if the Houthis really join this fight too. Or do you have to go north through Suez and then it gets kind of inconvenient. But yeah, both the Saudi and the UAE have a fair ability to bypass the strait. Qatar, Bahrain, Kuwait have, and of course Iraq have no such ability and essentially stuck.
Just a quick follow-up, Robin. What happens economically with these countries when the ones who depend completely really on oil exports and they can't get their oil out? I mean, how long before that becomes a fairly dramatic development for them, and it's very difficult to get through?
Obviously, it depends on the length of the crisis. Now, most of these countries have huge fiscal reserves, of course. So we talk about the UAE or
Robin, we've lost your sound a little bit.
Trying to speak up. If we speak about the UAE or Qatar or even Saudi Arabia or Kuwait, they have huge fiscal resources, of course, sovereign wealth funds. They can survive a shutdown or a substantial reduction of oil exports for months, if not even years. Particularly for the UAE and Saudi, which of course are exporting some volumes. And if you look at the rise in price, probably net on crude exports, they're probably not any worse off. Lower exports at a much higher price. Of course, their economies are suffering a big hit on all kinds of other things like tourism and travel and general business, and of course also spending a huge amount on military, on defence. But they are relatively more insulated. I mean, the two that are really vulnerable, Bahrain, which has, of course, much less fiscal resources, but it's a small economy, and you'd assume its Gulf neighbours will help out if necessary. And then Iraq, which is very exposed, very limited fiscal space, can't export. So Iraq is hugely exposed, and we'll see Iraq go into fiscal crisis very soon if there isn't a pretty rapid resumption of oil exports.
Thank you, Robin, for elaborating on that. Robert, let me come to you, and of course, we want to expand this discussion beyond energy issues and look at it a little more broadly. So introduce us a little bit. What do you assess to be, if you're looking at the economies of the Gulf, what's the key factor or the key prism that you think best describes the broader economic impact of this cascading disruption in Gulf economies?
Thank you very much, Bill. I think this all comes down to timelines. I mean, that's a huge part of this equation right now. I mean, and I'd look at the timeline dimension in three different ways. I mean, first, and most importantly on everyone's mind, what's the timeline for the end of this war, for this Iran conflict look like? We've heard from administration officials in Washington, a number of weeks. So there are baseline assumptions out there that these hostilities will end in about a month. That's what Fitch Ratings has come out with, and is so far, so they're not prepared to downgrade ratings for different government-related entities yet. But I think many people are preparing for a scenario where the hostilities and disruptions continue for longer than that. So I think at first, in the timeline of where the hostilities go from here, obviously a swifter end to hostilities is going to limit the negative economic implications and spillovers, but a prolonged conflict is something that many different folks within the region, governments, businesses, and otherwise, are very keen to avoid. So, secondly, what are the timelines associated with affected industries and their ability to recover? I mean, Robin mentioned tourism. You've got business travel. You have real estate. These are, I think, big. There's a significant pressure on these sectors, and we've seen some of that pressure reflected in equity prices over the last few days. The governments in the region can prop up some industries, more easily and quickly than others. But that's going to be a case by case basis depending on the industry affected. So again, we'll have to see what the timelines there are. And some industries are more important to these economies than others. Of course, we've spent the first part of this conversation talking about energy and energy commodities, obviously hugely important. We all know that. But other areas of the economy, tourism, for example, it constitutes about 13% of GDP in the UAE and is very important in other countries too, either as a large chunk of the economy already, or because these governments want tourism to be an integral part of economic diversification efforts. That's the case in Saudi Arabia. Oman's pushing in that direction too. So what does the future for those industries look like, not just the present? And then finally, and relatedly, the timelines associated with different considerations around foreign investment and also investments by sovereigns, the sovereign wealth funds and other state-linked investment vehicles within these countries. I think that there's kind of a mixed bag here in terms of potential implications. On the one hand, these governments have very ambitious targets for attracting foreign direct investment. And the current developments in the region certainly create a lot of headwinds for attracting FDI at the moment. It's just not great marketing material, and there's going to be a lot of work ahead for these governments, policymakers, and the like, to restore trust in the broader business environment and to encourage foreign investors to kind of pick up things where they left off, so to speak. When hostilities broke out. I think the more positive note, though, is that you do have very important investment vehicles in the country, in these countries, sovereign wealth funds, being top of mind, that are long-term investors. And, we've seen just relatively recently a number of these investment vehicles announcing new investment strategies for the next 5 years. So, you do have significant and influential investment vehicles with deep financial resources, able to think overall, over the long run, and also able to provide various forms of support to different industries and and I think that's going to be a major asset for these countries when the dust does settle and they think about the best ways to move forward, across a number of different parts of the economic policy domain.
Robert, let me just ask you a quick follow-up to what you've laid out so interestingly, and this is a bit sort of getting to the end at the beginning. So I'm really just asking you for a preview. But assessing the damage and the disruption of timelines that you've mentioned, are we talking about a paradigm shift in the way that the international economies are going to look at the Gulf and the way they have approached it over the last decade? Or are we looking at a situation of recovery and back to the status quo?
we don't know the answer to that yet. I think it's too soon to say. Of course, the unprecedented nature of of this conflict, the Iranian retaliation, I think that that's going to be hard for global business and investors to forget. But the big question is, how quickly does this end, and how does it end? I mean, if hostilities quickly wind down, oil prices stay elevated, and a number of those disruptions, which my colleagues here, Kate and Robin, have very articulately laid out, they're there, they're present, they're going to be difficult and have to be worked through. But if they are worked through, and we do see a kind of a net positive result on budgets across the region, hostilities down, and the new normal, so to speak, being one that is not ridden with very kind of disruptive activities coming through on a daily or hourly basis through the news feed, then I think the situation can be a bit more optimistic than where we currently stand today, and not necessarily a major paradigm shift along the lines of what you mentioned.
Thanks, Robert. Tim, you follow the economy in Saudi Arabia in particular, and you have for years from your former IMF perch. Aramco had some interesting public remarks yesterday and offered some figures, I think, about the energy disruption that Kate described at the outset. How do you assess this disruption on Saudi spending, foreign investor confidence, and pacing for Saudi's mega projects?
Good. Thanks, Bill. I mean, I think to set the big picture right, I mean, and maybe follow what Kate and Robin have already said, to me, the key thing that really came out of the Aramco conference call yesterday was the fact that, if the Straits of Hormuz stay shut, this is a major, major problem for the global energy markets and industry and for the global economy. It's a huge supply shock if this continues on. So, there are, individual effects and they vary by country, but the overall tone for the global economy is going to be one, I think, of higher inflation, lower growth, which then, of course, sets the external environment for the Gulf. Um, I think for Saudi itself, as I think Robin already alluded to, you have to play with the numbers. These are scenarios, not forecasts. But when I ran some numbers yesterday, if I assume that Saudi oil output is cut by 2.5 million barrels a day on a sustained basis, and oil prices average $90 on a sustained basis, then I get a positive impact on the fiscal position relative to the budget for 2026 for the Saudis. Actually, about a 1% of GDP improvement. That doesn't take into account any increased spending pressures that could come from having to increase subsidies, increase defense spending, and it doesn't take into account that non-oil revenues may be weaker if the non-oil economy slows as a result of the conflict. But I think Saudi, amongst the Gulf producers, is in the strongest position because of its investments in the past in the East-West pipeline. Um, of course, I think there are going to be questions out there in terms of, I mean, I think Aramco's given figures for the amount of oil that can be, transited through the pipeline to the West Coast. I think there are still questions about, the ability to load all of that oil for export at Yanbu port. But, I guess we will see on that. And then, of course, also risks in terms of the ships going south and whether anything materializes from there. But I guess as the first take to maybe I've given you a long-winded answer to a simple question. I don't really see any sort of pressures on government spending in a need to cut government spending as a result of this conflict. If anything, there may be scope to increase that spending in the near term. But that of course, then you take that to the broader economic level, and there clearly are going to be negative broader economic repercussions of this. I mean, I think others have already mentioned, tourism flows, business confidence, ultimately, the environment is clearly not conducive to investment, whether that's foreign investment or domestic investment. The extent of that impact, I think, goes to two factors. One is, how long the crisis continues, and secondly, how does the crisis end, and how does the rebound look like? I think ultimately the crisis shows the importance, and that all of these countries are on the right track in terms of trying to diversify their economies. This emphasizes again the importance of that, but it probably creates a more challenging environment going forward. The question is really, how much more challenging is that going to be? Is it marginal in that the rebound is may take a bit of time, but it gets pretty much back to where we were before the crisis? Or I think a more likely scenario where it doesn't quite get back to where it was before the crisis. And then the question is, how much does the bounce back fall short of where we were? I'll stop there.
Great. Thank you, Tim. Kate, back to you on the energy front. Could we dig in just a little bit more on the issue of the closure of the Strait of Hormuz, and maybe give our audience a sense of some of the factors that are being either contributing to the closure beyond the fact that it's physically being closed? What are some of the sort of elements that go into that, whether it's shipping and tankers or insurance rates or alternative for exports? And then maybe give us a sense about impact and the trajectory of the impact over if the fighting ends in a week, you've got one sort of trajectory of impact. If it goes on for several more weeks, is it just more of the same impact, or does it get exponentially worse? What about these issues?
Well, I think the longer it goes on, the more shutdowns you're going to have. I mean, already you've seen huge shutdowns in Iraq, which has really no other outlet. It has a northern outlet to the Mediterranean, but they've had to shut down production in northern Iraq, the Kurdish areas. So that's not really viable. I mean, Iraq is getting it from both sides because they've got the pro-Iranian militias that are attacking U.S. positions. You've got Iran attacking supposedly U.S. assets in the north. So the longer it lasts, the more, the longer you shut down production, the harder it is to bring it back up again. And I think we had the minister from Qatar talking about, they've shut down production at Ras Laffan, which is a huge complex. And it's all in one place because it was hit, I think it was targeted. So, and he did say that it would take time to bring all of these trains back online again. So the fact that you've got 20% of the world's oil, I mean, I'm counting crude oil and products that go through the Strait of Hormuz. You've got Saudi Arabia, and I believe it when Aramco says that they can increase their shipments through Yanbu to 5 million barrels and eventually to 7 million, because they have invested, they've got the pipeline capacity, they haven't done it, so it hasn't been tested. But I think when you have Amin Nasser, the CEO of Aramco, saying yesterday, we can do 5 million, you've got tankers that are loading, and you've got tankers loading from Fujairah. In fact, Murban crude from the UAE is actually higher than it was before, the throughputs. I think they can do up to 2 million. So that is going on, and that I think is it's like there's a pressure cooker, but you've got a few nozzles that are sort of helping. But I think the longer it lasts, yes, we are going to see more volatility. The IEA has announced that there will be a release from strategic stocks. It will be led by Japan, which is a big importer of crude oil, particularly from the Middle East, and LNG from the US, Australia, and from Qatar. So I think it's, a lot of it, you mentioned insurance. Of course, insurance costs have gone up. You've got a huge backlog of tankers waiting to go in, up to 1,000, according to Lloyd's Maritime Association of Lloyd's Maritime So it's that will take time. It's going to be disruptive. And gas is more of a problem. You've got storage levels in Europe are very, very low. They're like below 30%, I heard. That has to be replenished. So you're going to have this scramble for LNG, which we saw during the 2022 Ukraine crisis, when Europe and Asia were competing for LNG supplies. And of course, a lot of these contracts are tied to crude oil. So you've got gas prices going up, you've got crude oil prices higher than they were at the start of the year. Yes, they've come up from the 120 high, they're about 90 at the moment. So I think it's going to feed into others. And let's not forget, there's also a problem with oil products. A lot of refineries within the region. There's only Saudi Arabia and Oman that have refineries that can supply a refined product like diesel and jet fuel and gasoline and naphtha to Europe and the rest of the world, but the others can't. The UAE can't, and Kuwait, which is one of the biggest refineries. So we've seen the Ruwais refinery in the UAE was hit, and even if it weren't, it still couldn't export. So I think you've got an issue. You already had a problem with diesel prices in Europe because they weren't importing from Russia. So you do have buffers, and I think that's one of the reasons why we haven't seen prices go much higher, because you have buffers. Saudi Arabia anticipated that there might be that this might happen, that there might be an attack on Iran, so they were increasing production, shipping more crude, putting it in storage close to their consumer bases. The UAE did the same, Kuwait did the same. China has been building huge amounts of stocks. In fact, their stocks, their oil reserves, which we don't really know exact numbers, but they're over 1 billion, around 1.2 billion. So that's a buffer. China can survive. Japan has huge buffers. So I think that has helped to sort of keep the price in, from really, really going much higher than this kind of crisis would normally have led to.
Just one follow-up, Kate. We have a question from Nimrod Novik. He's asking about, we've talked about this a little bit, but maybe you could expand on it. UAE pipeline capacity being limited, and
it's not.
Yes.
No, it isn't. It isn't limited. We're seeing higher volumes, but of course, much depends on whether tankers, whether storage fills up. They do have storage as well, so I think that's why we're seeing higher numbers. But it's whether tankers, you've seen Salalah hit today in Oman.
Mm-hmm.
That's really far south, much further south than Fujairah or Duqm. So if tankers are not willing to go in, or if insurance rates, you mentioned insurance, you've got freight rates, you've got insurance, you've had tanker shortages anyway. It's a combination of all three that's leading to it. But no, I don't think there's an issue. It's just a security, whether tankers can load, whether you see more attacks. We have seen attacks on Fujairah. And if that continues, then yes, tankers won't be able to load. You're having to also change the grades that you can export. Saudi Arabia can export light grades from Yanbu, as opposed to the heavier grades. So you're going to see a lot of changes in the differentials between the various grades. If the US starts exporting more, that's another light crude. So you're going to see this sort of imbalance, and not all refineries can deal with it. And also, let's not forget that Europe shut down so many refineries that they become more dependent on imports of refined products, a lot of it coming from the Middle East.
The other part of his question, Kate, focused on, and you've talked about it a little bit, and Tim mentioned it as well, as Yanbu, the terminal destination for the Saudi pipeline. Any capacity limitations there beyond just loading of tankers?
No, they do supply their refineries as well on the Red Sea coast. But I think they seem to be quite prepared. They seem to be loading from Yanbu, and again, the only thing that can prevent this from happening is, let's not forget, they also have storage in the Gulf of Suez. So that also helps. But the only issue there is whether there's going to be a problem with the Houthis sort of coming into the conflict, which they haven't so far. And in fact, I suggest that people read what we have that we've written about on the website about why the headline is the Houthi conundrum and the war in Iran, why they haven't attacked shipping, which we saw before during the Gaza war. But it's a different war now. Are you going to sort of risk your own survival in a very different Yemen to the one we even last year? So I think that could be the only risk if you can't go through the Bab el Mandeb. But for now, it looks as if operations are continuing from Yambo. We have seen sort of strikes, attempted strikes on one of Saudi Arabia's biggest fields, Sheba. We've seen Ras Tanura has been hit, one of their refineries. So it's it's still very, very shaky. You can't really say that everything is going to be flowing normally because we don't know how Iran's going to respond.
Thanks, Kate. Robin, we've had a good sort of consideration of issues so far as we've gotten into this. What would you say, if you're looking at the discussion we've had, what are we not focusing on, or what have analysts in general and observers not sufficiently focused on as a part of this crisis that's critical to it? Is it markets that aren't accurately estimating geopolitical risk? Is it real vulnerabilities in the global energy supply? What would you say is a key element to the discussion that needs to be added?
Yeah, I would really say three things. The first of those is the disconnect between the financial and the physical markets. And as I said, I think when I started, the physical market is under no illusions about how serious this is, and that this is not an $80 or $90 a barrel problem. This is a $120, $150 a barrel problem, and particularly if it persists. And I think that has all been muddied by the attempts of the US administration to talk this down by Donald Trump and Energy Secretary Chris Wright and others to suggest that the war will be over soon, or there'll be some solution, maybe to get tankers in, that a tanker has already gone through with the US military escort, which was then denied, and so on. And this has caused temporary drops in price, and made people very worried about going long in this market when they could be undermined by a message like that. But those illusions can only be kept up for a short time. And as it said, you may start a war when you will, but you cannot end it when you may. And just because the US declares victory doesn't mean that this war necessarily ends. The intensity might wind down, but we could still have a long period of insecurity and chronic threats to shipping and so on. So that's the first one I point to. Mm-hmm. The second one is related, and that is the danger of physical damage to infrastructure. And I think, again, the market has been complacent. And it has said, look, so far, ships aren't sailing, but, that's fine. Once the crisis is over, the ships will sail again. And perhaps it takes a month or two to sort everybody out and get everybody back to their starting point. But then the crisis will be over. And that's assuming there is no serious physical damage. And we have seen attacks on Qatar's liquified natural gas facilities, on refineries in Bahrain, Saudi Arabia, oil storage facilities in Fujairah, and just today on oil storage in Salalah in Oman. Oman has been neutral in this, and Salalah is a long way from the Strait of Hormuz, and yet oil storage tanks have been, as far as we understand, destroyed there. None of these things are that serious in themselves yet, but there's obviously the risk that something really important and not quick to replace gets hit and put out of action, like the AGSI facility in 2019. That could happen again, but perhaps something that can only be fixed after a period of months or even years. And the third risk I see is all the other commodities that come out of the Gulf. It's not just crude oil and LNG, it's refined oil products. The Gulf is a huge supplier of jet fuel and diesel to Europe. So there's all the refined product side, and then all the other commodities, petrochemicals, plastics, aluminium, methanol, fertilizers. The Gulf is a key supplier of all of those to the world economy. None of these things are commodities that can be replaced very easily, and they're all critical. I think there's more talk now about fertilizers. People are waking up to this. We're entering the Northern Hemisphere planting season. The Gulf supplies about a third of the world's nitrogen-bearing fertilizers, and 3/4 of that is going through the Strait of Hormuz. So that we give that 2 more months, and that's cut off, and there's a significant shortfall of fertilizers for the growing season. So these are risks I think people are just starting to wake up to as they look down the supply chain.
Just a quick follow-up and give you just a minute on it. You talk about the markets essentially underestimating geopolitical risk here, or I mean, some markets are not underestimating it exactly, but they are not. It's not being reflected accurately sometimes. Can you talk a little bit more about the dynamics of that? What is it? Just a function of U.S. Messaging efforts, or are there other factors involved in that?
Well, I think there's a couple of things. One is US messaging, and the Brent crude price did go over $120 per barrel briefly when the market reopened on Monday, but it then very quickly fell back because of these warm words from Donald Trump and other administration officials that the war would be over soon, and there were solutions and so on. That obviously hasn't materialized. But as I said, I think traders are going to be pretty reluctant to go long in this market if they could then be enormously exposed. This is a very hard market to trade. In the good case, that there's a ceasefire and we're back to normal at least within a month or two. In the bad case, it drags on for months and there's permanent disruption of oil supply and gas supply out of the Gulf. How do you trade when a market could be down at $80 or $70, or it could be up at 150? Your financial exposure is huge, whatever your conviction may be of which way things are going. So that's one problem. And I think another problem is there's been a kind of crying wolf problem, right? That for years there's always been worries about Hormuz, and some Iranian general will say, "Oh, we're going to close Hormuz if this or this or this happens." And of course, nothing serious ever does happen. Maybe now and again a ship hits a mine and there's some minor damage or something, but nothing that was ever anywhere close to closing the strait. But we talk about geopolitical risk, and this isn't geopolitical risk. It's really happening. This is not a hypothetical that something in the scenario that we maybe get worried about. This is happening right now. Ships are not going in, not going out. Ships are getting damaged. 3 ships damaged today. One of them seriously. So it's a very real occurrence. And I think that makes it very different from the speculation in past years where you might say, "Oh, we better put $1 or $2 on the oil price just in case."
Thank you, Robin. Robert, let's look a little bit at the economic side of this again. What are the longer term issues around capital flows, financial capital flows, human flows, and their impact on business confidence emerging from this crisis? And maybe give us a sense as well about how you see recovery when we do get to that point.
Sure, Bill. Yeah, well, there have been longstanding concerns about outflows, especially driven by conflict and these types of events. Outflows, both from a financial investment point of view, but also expatriates. And I think these have been reasonable concerns over the years, given the prospect for such a conflict, but also the population demographics in the region. Look, if we were to look at some of the reactions that we've seen in regional stock markets, like I did for a recent piece with the Institute, I mean, we've seen kind of mixed reactions. In the first week of conflict, there were initial losses across indices, but then a number of Gulf stock markets actually climbed. The UAE had a really tough week, so it's kind of both across different stock markets and within markets in different industries and different equities. We saw a range of different price movements. As of today, a lot of the major Gulf equities, they did open higher when I checked before our call. I mean, albeit I'll say that there's been a lot of volatility, so take what I say with a grain of salt, and you have to keep verifying these figures. But we've seen the UAE have a recovery of sorts after a really tough first week. We saw trading suspended on the Dubai and Abu Dhabi markets for a couple of days at the outset of the week. And in the first week, Qatar's stock market was doing pretty well. Now, as of today, the index was down. The Qatar National Bank was under pressure. And we see a little bit of a better story in Saudi Arabia. This is kind of reflects some of the more positive sentiment that my other colleagues here on the call have been, I think, have expressed when it comes to Saudi Arabia's position here and where that's likely to be going forward. Oman has actually, if we look across the board at Oman's stock market performance, has actually done relatively well. And again, I think a reflection somewhat of Oman's position diplomatically and to some degree the geographic maneuverability that it has. So, I mean, this is on one side of things. I think there's also a human capital dimension to this, to some of the longer term issues here. We know that multinationals have been dealing with issues around their staff, and they have to think very carefully about operational continuity. And what we've been hearing is that some expatriates, we know, have opted to leave for a period of time to relocate. Some have been forced to leave because of business-related reasons and insurance as well. So, when will they be able to get back, and what type of impact will that have on business operations? These are ongoing questions that that we need to think about. There's another demographic that's important for some of the countries in the region too. The high net worth individuals and ultra high net worth individuals. I mean, there are a lot of these, albeit a small but influential demographic in the UAE, especially in Dubai. Deep pools of private wealth, outside of just the deep pools of sovereign wealth that we've talked a little about today. So this will be another kind of important segment of the demographics to watch over in the months and years ahead. And I think finally I'll end it with more of an outlook. I mean, of course, it's important to think about what's happening now and how that is going to impact the region going forward. But I think at times,
I think we've lost you, Robert.
oh, can you hear me now?
Yeah.
Yeah.
So I'll just back up and say, it's really important at times like these to think about what's going on in the region and how this is going to impact different countries, governments, and sectors going forward. But it's just as important to think about what was happening in the region.
I'm losing you again.
Oh, sorry about that. Why don't we switch over, Bill, and see, and we'll come back to me, and I'll see if I can finish up again.
Okay, Robert. Tim, let's talk to you for a second. We've covered this a little bit, but give us your take on a lot of these Gulf countries have very ambitious long-term development plans. They have energy diversification plans that are sort of projecting out sometimes 10, 20 years. Is this crisis something that's just going to be a little blip on the screen, so to speak, and in 5, 10 years it won't, or even a year, it won't have much impact? Or is this a crisis that's going to have some impacts, whether direct or indirect, down the line on these countries' abilities to complete and to further plan these ambitious energy diversification plans and development plans?
Yeah. I mean, I think there is no doubt that all of the Gulf countries are going to want to continue with their diversification plans going forward, right? I mean, they realized that they can't continue to be as dependent on oil or gas proceeds as they've done in the past when they put these in place. And I think the current crisis will only emphasize the importance of being diversified. I think, the bigger question is, of course, to do that, you need people on the other side who want to come in and, be tourists, work in the country, set up businesses in the country, invest in the countries. And, the question is going to be, how does the crisis or, the conflict affect that in the, medium to longer term? And I think part of that clearly depends on how people perceive, the risks from Iran in the future when this conflict has ended. But it seems that, surely is going to be some recalibration of those risks in an upward direction, given what we've seen. And then I guess the question is, how does that affect, again, all of these industries that are, trying to be developed? For a while, I've been concerned that there is, excess capacity developing in some of these areas. Everybody in the Gulf is often trying to do the same thing, whether it's tourism, whether it's AI, whether it's logistics, and so on. And, does the current conflict, sort of heighten the potential excess capacity in some of these areas in the region? So, for example, clearly, particularly UAE, Qatar have become, huge hubs for airline travel, and that's been significantly disrupted, right? Somebody was on CNN last night saying, the cost of flying from the US to India has risen 50% because of the inability to go through the Gulf. So do we see some recalibration of how people want to travel after this crisis because of the concentration of risk in this area in the Gulf? Similarly, how does the future look for AI data center development in the region, given there have been attacks on facilities? Clearly, the region has many strengths in terms of attracting investment in that area, but there are also maybe heightened risks now perceived in this area. So that's another potential logistics I think you could put into the same camp here. So I guess my bottom line is that you know, the countries themselves are going to want to continue to move forward with this. The question is it going to be more difficult from the point of view of what they're trying to attract in terms of people, goods, services, investment? My sense is yes, it will, but I think it's very uncertain whether that change is relatively minimal or more substantial, and that's going to be at this stage the key unanswerable question, which we'll have to see once the conflict ends.
Thank you, Tim. Robert, you had your hand up. You want to append a bit to your answer?
Yeah, if I can. Hopefully the sound is back here. Just to pick up on what Tim said on the AI front, I think it is going to be useful to look at how the conflict is impacting some of these high priority sectors like AI. But I think it's going to be potentially more useful to look at what these Gulf governments were doing even before the conflict as an indication of what they're likely to continue to do, over the medium and longer term. And I think the AI industry is one of those, is one sector where that analysis is particularly useful. I mean, you've got the added benefit in the region of national champions, tech firms like G42 and newer ones that have emerged onto the scene recently in Saudi Arabia and Qatar, who are going to be pushing ahead there. Albeit, given the recent developments in the region, there may be some tweaks to strategy. There'll be additional efforts required to safeguard infrastructure. Absolutely. But I don't think there's going to be a complete U-turn, on the tech strategies and longer term tech initiatives. What will probably change is the timeline of where financing responsibilities fall. And I think across the board in many of these countries, the governments were hoping to kind of lessen their financing obligations across a number of high priority industries. And I think that the developments in the region and the Iran conflict is going to mean that these governments are going to be on the hook for more and for longer. But I think that's a pill that they're going to be willing to swallow.
Thank you, Robert. Kate, I'm going to come back to you. I see you have your hand up. I also want to add something for your consideration. One of our panel members, a bit more political, but throw it into the mix as you're closing out here. And by the way, we have a few minutes to go. I'm going to try to circle back and let everybody have about a minute at the end. And I'll give you something like that, and I'll give you a prompt to answer. But just to give you a sense about how we're going to close out. Kate, we have a question. It says, given President Trump's hints that that this conflict will not last long, and his quote unquote preemptive statement to that effect on Sunday, should we expect him to declare mission accomplished just hours before the stock market opening on Monday?
He might, we might have a tackle moment, as they call it, but you also have Israel. This is a joint operation. This isn't just the US, it's a joint operation. And you've got a hardliner now in charge in Iran, supposedly maybe injured, but still in charge. It's emboldened them. Their backs are against the wall. You've got the IRGC, which has a lot to lose. They control a lot of the economy and they benefited from sanctions. They're not going to give up so easily. So I think, he might declare that, it's mission accomplished, he said, but his Secretary of War says, oh, it's going to, the worst is yet to come. So who do you believe? There's so many conflicting messages coming out of there. But, one thing we did mention is while we were on air, the IEA has announced that its members will be releasing 400 million barrels from strategic stocks. That's probably going to be crude oil and maybe products. But the price of oil didn't really change very much. So it was already priced in because there's been talk about this for the last few days. So what happens next is, what is going to impact the price of oil beyond this release, which is the biggest in history. The last time we did it was in 2022. So I think what we have to look for in the future, and this is sort of my final thing, is how these high prices, because we have seen a huge, huge volatility, how it's going to impact demand in the future. Are we going to see countries, and already we're seeing it in some Asian countries, where they are introducing 4-day weeks, telling people to stay at home, people in Manila using public transportation instead of cars because the price of gasoline has gone up, what the Western governments are going to do in order to sort of shield consumers from this price rise, because that's also, politically difficult. The US cannot afford to have high gasoline prices because that's going into sort of midterm elections. So I think how much demand destruction we see as a result of this, how much fuel switching we see is something that we need to watch for in the weeks and months ahead.
Thank you, Kate. Robin, I want to come to you for a question, and we'll consider this also the beginning of our closeout. So I'll give you about 30 seconds or so to answer the question, and then you can take a minute or so to close out. And I'll give you the issue I want you to focus on in that closeout. But here's the question we have from the audience. What is the likelihood that this Gulf energy shock will lead to a significant, this is a little far afield, but geographically, but give us your sense of it. The likelihood that this Gulf energy shock will lead to a significant turnaround in Venezuela's upstream oil industry, irrespective of the current government in power. What kind of impact do you see there? And then the question I want to ask everybody, and you'll have about 30, 40 seconds to answer, is if there's one factor you'll be looking at in the coming week or two to gauge where this crisis is headed, what would it be? Robin, we'll start with you for both of those issues.
So in Venezuela, yeah, I think it gives a little bit of an impetus to invest in Venezuela, and both Chevron and Shell signed pretty big, although preliminary deals yesterday for development of oil and gas, some major oil fields in Venezuela. So I think companies are getting more confident. And I do think this, following the abduction of President Maduro, then this war in Iran will certainly make the new Venezuelan government keen to stay on the US's good side and make sure that all investment is coming in. We've heard all the issues about Venezuela, insecurity and corruption and failing infrastructure, and it's mostly heavy oil and so on. So there's plenty of reasons Venezuela's not an easy place to invest. But yeah, there's clearly going to be more interest. But don't expect hundreds of thousands of extra barrels per day coming out of Venezuela anytime soon. This is still a multiple year process to really get Venezuela back to where it was 10 or 15 years ago. I do think there's a wider question there, which is a little bit longer term, but what impetus does this give to oil and gas development globally outside the Gulf? And I think certainly it's going to give a significant push to the LNG sector, and some project that maybe wouldn't have gone over the line previously will now get over the line if this crisis persists a bit. But in terms of what I'm watching, look, the crucial thing for now is, our tankers are going to start moving. Are they going to start coming out? And I can imagine that some do, as I said earlier, and I run the gauntlet. But perhaps more importantly, are they going to start going in? Are they going to get confident that the security is good enough for them to go in, load, come out again? And I don't think we're anywhere near that right now.
Okay, Robert, we'll pop over to you on the economic side, you and Tim, and then I'll give Kate the final word. Everybody's got about 40 seconds.
Okay, I'll keep it brief. I think a clearer indication of the duration of this conflict, and that there are different signposts you could look for. I mean, Robin mentioned a good one: traffic going in and out of the Strait of Hormuz. I mean, that would be an example of, I think, things moving in a more positive direction for this conflict. You could also look at the nature of different assets being targeted. Over the past week or two, we've seen, I think, a racket or an upping of tensions and an escalation of tensions based on what assets have been targeted. I think many of us would like to see things moving in the other direction. So that's what I'll be looking for.
Thank you, Robert. Tim?
I have a simple one, the oil price, which I think, coming back to what Robin said earlier, right, if supply through the Gulf of Hormuz is going to be down, whatever the number is, ultimately 8, 10 million barrels a day, you're going to have to see prices rise substantially to restore some balance between demand and supply. So, I like things I can just very quickly look up online. So the oil price is the one for me.
Thank you, Tim. I assume when you say substantially, you're talking about north of 100.
Yeah, I mean, I would say probably north of 120 if we don't see some efforts to sort of free shipping up and something start moving.
Kate, final word?
Final word is, I mean, we've seen one desalination plant hit by Iran in Bahrain. We've seen another one in Iran. I'm looking at whether Iran will sort of target soft targets, so to speak, desalination plants, which so far they haven't done, because that would be a really dangerous escalation, which would make, which the Gulf countries are very vulnerable to. And I think what's happened now is it has set a precedent. We've talked for years, decades, about the possibility of the Strait of Hormuz being shut down. I've always said, physically it never has been. It has happened now. So if you don't get regime change in Iran, which we don't even know if that's even one of the goals of this campaign, then you've got a precedent and it can recur. So that's what I think I'd be looking at in the future.
Thank you, Kate. And thank you to all of our panel members. This has been a really interesting discussion. We will continue to follow the issues out in the Gulf resulting from this military conflict. We'll do that on the publication side and on the program side. I want to thank our audience for joining us today, and we look forward to having you consume our material on the website and also join us for future programs focused on this and other issues. Thank you very much.